My name is Simeon Friedman. I'm a partner at Saul and Friedman and Company, an accounting firm that was formed by my dear father, Saul, over 45 years ago. Back then, at a time when a Hamish firm was pretty much non-existent. Saul Friedman and Company is a proud gold sponsor at this year's JCon event. The perspective out there is that accountants are a necessary evil. When things are good, we are the bearer of bad news as it pertains to taxes. When things are bad, we again are the bearer of bad news in saying, hey, things are bad. You're not doing so well. You have to do things to improve your business. But as you all know, all of you need an accountant at some point every year. However, as a proud advocate of my profession, I say having a good working relationship with your accountant throughout the year can alleviate frustrations down the line. When you need a report to your investors, an accountant throughout the year can help so that they can be assured that the information provided are timely and accurate. When you have the pressures of having your tax filings prepared timely so that investors' K-1s can be issued, having an accountant throughout the year can help as well. When you're contemplating a real estate or financing transaction, you'd want to make sure that it is structured in the best manner possible in all aspects, business, legal, and most tax advantageous. This, again, requires, throughout the year, guidance from your accountant. So in short, yes, an accountant can be utilized solely for year-end tax preparation, but as you grow your business or increase your real estate holdings, know that there is much more value an accountant can add throughout the year. Thanks for giving me the opportunity to introduce myself. And without further ado, I'd like to introduce the speaker for this class on tax strategies, Mr. Michael Brady.
Great, thank you. Can everybody hear me okay? Okay, levels are okay for the recording over there? Okay, great. Yeah, that couldn't be more true. The accountant plays a huge role in any type of transaction, but particularly in real estate. And one of the first things that I do, first of all, let me introduce myself briefly. My name is Mike Brady. I'm an executive vice president with Madison Exchange, Madison 1031. We are a qualified intermediary for 1031 exchanges of real estate. Today we're going to cover a couple of different tax strategies. 1031 exchanges.
You're the Mike Brady who doesn't have 6 kids.
No, I don't have the 6 kids. I have the 3 boys that didn't quite get the girls. So, and I'm also not related to the quarterback, unfortunately for me. So we'll talk about 3 different strategies. We're going to talk about 1031s, we're going to talk about cost segregation studies, and we're going to talk about qualified opportunity zones as well. Is everybody familiar with qualified opportunity zones? Okay, so there's some exciting things going on there. And we're a small enough group, I'm more than happy to answer your questions. If it's something I think I'm going to cover anyway, I may just put you off until I get a pretty picture on the television, but we'll go over as much as you want. So my background is I'm an attorney. I've been practicing law since 1994, and one of the first projects I ever worked on was a 1031 exchange. I walked into a law firm, the small law firm that I worked for, and a partner said, we have this great project. Client wants to exchange his house, his 6-family house in Jackson Heights, and he wants to buy, something that he can develop. I said, great. What's a 1031 exchange? He said, I don't know. It's something to do with taxes and real estate. And what I ultimately discovered was that after many billable hours of trying to figure out what a 1031 exchange was, what I really needed was a good qualified intermediary to walk me through the process. And by doing that, our client sold that 6-family house in Jackson Heights. Probably right now with rent stabilization changes, he's probably pretty glad that he did that. And he bought a building lot in Southold on the east end of Long Island and probably turned that into a several $million-dollar single-family house and ultimately sold it. So that's kind of what I do. That's my background. And as I was saying, in the course of doing 1031 exchanges and any of the transactions we're talking about, the accountant plays a critical role. And you really want to get them involved as early in the process whenever you're planning investment or planning to sell an investment, probably more importantly. And, if you wait until after, it's often too late to do it properly. So let's talk about 1031 exchanges to start. How many people in the room are familiar with 1031 exchanges? Okay. How many people in the room are investors? Okay. Accountants? Okay. Attorneys? Okay, so I know Stephen Jasmine's an attorney, so we'll go easy on the attorneys when we talk about people today, but typically they're the ones that give us the most problems when we're trying to structure transactions. So 1031 exchanges. So why do we do this? Well, if you're selling investment real estate, and this applies to investment real estate, you're going to pay taxes on the profit, okay? And the taxes may eat up more of the profit than you otherwise would think. So let's take a look at a typical transaction. We had an investor, let me talk about tax rates first. So the various levels of taxation are as follows. So we have a federal capital gain rate, okay, and we have a couple different rates up there. There is a 0% rate that's out there for some investors. That's not going to be anybody that's selling commercial property. Most people are going to be probably in the 15% bracket. That's federal long-term capital gains rates. That's if you have adjusted gross income of up to $434,550 and $448,850 as a married couple filing jointly. Okay, if you exceed those thresholds, you'll have a rate of 20%. You'll pay a 20% capital gains tax for federal purposes. And this is long-term capital gains. That means you've owned the property for at least 1 year and a day. If you sell the property before owning it for a year, you pay income taxes, which is a much higher rate. These are the preferential long-term capital gain rates. In addition, in 2013, they added what they called a net investment income tax. It's sometimes referred to as the Obamacare tax because it kind of came in and was supposed to help pay for the ACA. And that's an additional 3.8% for taxpayers who make $200,000 as a single person or $250,000 as a married couple filing jointly. In addition, how many people are familiar with depreciation? Okay, so depreciation is one of the biggest benefits you get from owning real estate, right? You get to take a portion of your investment in the property and you pull it out as an expense every year against your income, right? You can't do that with stock. You can't do that with most other investments. So that's a huge property tax advantage, and we'll talk about cost segregation studies and how that helps as well. But the problem is when you sell the property, that gets recaptured. And that means whatever you've taken out as depreciation as a tax deduction, you now have to repay at a rate of 25%. Okay? So that's federal depreciation recapture. Then we live in the tri-state area, New York, New Jersey, Connecticut. We pay state income taxes. We're not fortunate like Florida, Texas, and some of the other states where we don't have state income taxes. New York, New Jersey, the maximum marginal rate is 8.97%, almost 9%. And if you're selling property, most of the tax, it's a marginal rate, but most of what you're going to pay is close to 9%. And lastly, of course, if you have property in the city of New York, you get to pay up to an additional 3.648% on your profit. Okay, so we're talking about when you sell appreciated property, you're taking 1/3 of that profit almost off the table, and that's gone and going to pay various levels of government. That's gone so that New York City can basically limit your rents on your rent-stabilized building, and various other things that you may or may not approve of. So what does this look like practically? So if we had a taxpayer who bought a property for $5 million, and over the course of their ownership, they improved it by $1 million, okay? Also, during the course of their ownership, they depreciated it by another $800,000, right? They took that tax deduction and it wound up being $800,000 over their life of the property. That gives them a net adjusted basis of $5.2 million. Okay, so it's the $500,000 plus their improvements, less their depreciation, gives them a $5.2 million basis. Okay? If they were to sell that property for $10 million, to calculate the capital gain, we take the $10 million, subtract out the net adjusted basis of $5.2 million, and subtract out any cost of sale they may have, like things like their transfer taxes, their realtor commissions. Those are usually the two big items. Attorney's fees. That gets deducted as well. That would leave them with a profit or a capital gain of $4 million. Okay, not bad on a $5 million investment. They have a $4 million profit. But that's not what they get to keep, right? So, oops, that slipped by very fast. Okay, so $4 million capital gain. We have to pay taxes. First level of tax, depreciation recapture. That $800,000 gets taxed at a rate of 25%. That's a $200,000 tax bill. Federal capital gains is going to be 20%. That's $640,000, okay? Federal net investment income tax is another $121,600. State income taxes come to $358,800. City income taxes are $145,920, leaving a balance of $2.5 million. Okay, so they started off with $4 million of profit, and they walked away with $2.5 after paying various levels of government. Still not a bad profit, but if you think about it this way, they had paid $1.466 million in taxes. Okay, that's bad enough. But think about, many of our clients, most of our clients, in fact, will leverage up. So they'll take their $10 million property, and they're not going to go replace it with a $10 million property. They'll replace it with a $15 million property or $20 million property, especially if they don't have much debt. So if you take $1.4 million off the table, and let's say you were able to keep that and leverage it at 75% LTV, well, that would give you an additional $5.8 million of purchasing power. Okay, so by paying taxes, you've lost $5.8 million of potential purchasing power. Okay, and that's why we do exchanges. Think of it as taking this $1.4 million that you otherwise wouldn't pay the taxes and treating it as a term-free, interest-free loan from various levels of government to go buy bigger and more profitable property. Does that make sense? Okay, and that's why our clients are doing exchanges. So how does it work? Well, we look at Internal Revenue Code Section 1031, okay? And it's dinner time, so I hate reading the tax code when people are thinking about food, but, and otherwise at the end of their day. And Section 1031 provides no gain or loss shall be recognized on the exchange of real property held for productive use in a trade, business, or for investment, if such property is exchanged solely for real property of like kind to be held for productive use in a trade, business, or for investment. Okay? What does that mean, right? This is what a young Mike Brady basically discovered in 1994 when we went to the court library and looked at the tax code, which he had to dust off because nobody had looked at it in 20 years. And essentially, I looked at it and it made no sense to me. But if you break it down, it basically says that to avoid paying taxes when you sell real estate, you have to trade it for other real estate. Okay? I'm camera shy. Okay. So simply said, you basically just have to exchange one property. This is a really buggy remote. Oh. Bear with me. We went ahead about 20 slides. Don't look. Okay. So essentially we have to trade real estate. So, and the whole concept behind this, which I think a lot of people miss, is that if two parties had properties that the other liked, and they just basically traded deeds, that is automatically a 1031 exchange, right? And that's the whole rationale behind here, is that parties basically trading one for the other. Well, there's no cash in that transaction, right? It's just property for property. So if you do that, how are you going to pay taxes? There's no money to pay the taxes because all you've done is just got one property for another. You've never touched cash. So that is what the whole concept of a 1031 exchange is. They've made it a lot simpler for people by allowing a third party into that mix called a qualified intermediary. So for tax purposes, what happens is you have this qualified intermediary, a company like Madison Exchange, our company. They actually act as a middleman. So the taxpayer, for tax purposes, gives us their property, right? Is part of the trade. They give it to us. We don't have a property to give them. So what we do is we sell it. We sell their property and we take the money from the sale and we go buy a property from somebody else. And then that way we give them that property. So they've exchanged with us. Does that make sense? So essentially, we're taking their money, buying a property, so they're getting a property for a property. They're never touching cash because if they touch the cash is taxable. So they're getting a property for a property. Now, if you've done a 1031 exchange, you know that that's not what really happens, right? We very rarely will take title to a property. We do it with reverse exchanges, which I'll talk about, but we typically don't do it in any kind of forward exchange transaction. So they've created regulations to make this much simpler. Because if I had to take title to the property, it would be a very expensive transaction, right? We'd have two sets of transfer taxes on each side of the transaction, right? That's not insignificant, especially in New York City. In addition, we'd have two sets of recording fees. The title guys in the room would love this transaction because we'd have to have 4 title policies in this entire transaction. They do this all day long. But they made it much simpler. So it's sufficient as long as the money just flows through us. We take assignment to both contracts and we receive the money. And they say that that's the same as if the parties swap properties. Okay? Let's talk about like kind. So I mentioned like kind, and sometimes people get confused in that at 1031 exchange. They figure, well, I have a 6-family apartment building. I have to go buy an apartment building, right? That's like kind. It doesn't mean that. Like kind in the context of real estate means that they are both investment real estate. Okay, so you can exchange, and I don't know if you can see it, we changed the coloring on this and I'm not thrilled with it, but you can exchange an apartment building and you can go buy a factory. You can sell a factory, you can go buy a farm. You can sell a farm and buy what I got? Office building, apartment building. An apartment building you could sell and buy a single-family rental residence. It just has to be investment real estate. You cannot go buy a primary residence. Okay, that's not investment real estate. It might be a very good investment, but it's your personal use. That's different. Okay, you might be able to buy a vacation home depending on how often you rent it. If you have a lot of rental use in your vacation home and very minimal personal use, and if you have questions about that, it's a little bit, we don't have a lot of time for me to address that. I'd be more than happy to answer those questions if you have that. Okay, so, but otherwise, it's really something income generating or something you operate a business out of. Okay, so what does it look like? I guess, what? It's actually the computer. Okay. Problem is I just have a heavy trigger finger. Okay. So we have a delayed exchange. This is your typical forward exchange. This is probably what everybody in the room is familiar with. So you have two parties that basically come to an agreement to sell a property. You have the exchanger is the one who's selling. He doesn't want to pay taxes. So he contacts his qualified intermediary. When does he do this? Any time before closing, right? If you close and then decide to do an exchange, you are out of luck. Okay, it's too late because it has to be an exchange. If you touch the money, or if the money is even, I get this question all the time, I want to do a 1031 exchange, but I closed 2 weeks ago. And you tell them, well, no, I'm sorry, it's too late. And they say, no, it's fine. I got the check, but I didn't cash it, right? It's a good try, right? It's a good try. But the problem is you had control. Once you have control of the money, it's too late. So you set up before, you contact us before. Who else do you talk to before you do the exchange? Your lawyer, that's a good question, but that's a good one. Your accountant, thank you. You talk to your accountant, okay? So now we've done all that. We have our documents in place. You go to closing. The exchanger deeds the property to the buyer just like they always do. The buyer pays us. Okay, they paid the net proceeds, net of mortgage, net of closing costs. They then have 45 days to identify their replacement property and up to 180 days to close on it. Okay, they find that property that they want to buy. They go to closing. We spend the money. We pay the seller the net proceeds from the funds we were holding, and the seller deeds the property directly to the buyer completing the exchange. Okay, pretty simple. It's not that different from your garden variety real estate transaction. The only difference is we hold the money. Yes, you had a question?
Is that true for all 1031s? It's not for till a year?
It's not for, I'm sorry.
The time period.
Yeah.
Term allowance is not a full year?
It's not a full year. Yeah. So the question is, are these time periods applicable to all 1031 exchanges? And for practical purposes, yes. You only have 45 days to identify and 180 days to close. And for some reason, it's funny because I've done presentations. I've done these since 2005. I've been doing these almost one a week at least. And I have people come back to me years later and say, oh, I attended your presentation. I have an exchange for you. I remember the deadlines. I have 6 months to identify and 1 year to close. Or I have 75 days to identify and 90 days to close. People forget the dates. So we do this every day, so we know it, but it's 45, 180. Okay? Any other questions? Not a lot of time. The 45 days goes by real quick. And what do you have to do in the 45 days? You have to give me typically a list of up to 3 potential replacement properties that you're interested in. Okay? Yeah?
Does the 180 days start from the end of the 45 days?
No. The question is, is it 45 plus 180? And no, they run concurrently. It's 45 days plus 135 to get to the 180. Okay? Yes?
I've done a number of them. I just wanted to share this with people. The 45 days is really misleading because it says to identify 45
Right.
days. That's like saying, I see those 3 women over there. I'm going to marry one of them. But after you ask them, after you do, you wind up you don't want to marry either of them.
Right.
Okay?
Or they don't want to marry you. That's the other.
Stuck.
Right.
So the truth is, you really shouldn't be identifying in 45 days. If you want to have a successful 1031, in my opinion,
Right.
you should actually not only be in contract and perhaps even
Right. Yeah, and that's a good point. The 45 days goes by very quickly, and I always say the people that get the 1031 religion at the closing table are usually the ones that are getting their money back on day 46. Because especially in this market, we are in still somewhat of a seller's market. It's very hard to find an adequate replacement property. I hear it all day long. Inventory is an issue. People cannot find something suitable in 45 days. And so I always say you want to start shopping at a minimum at the same time you're listing your property, if not sooner. Okay. We do have the ability.
A trick to the trade is tell them that the 45 days really start at the time that they sign their contract.
Yeah, you could tell them that. Yeah. That works. Yeah. So the other way to do this, which may make more sense, is you could find the property you like first and close on it and then sell your property. Okay? You may know that you have gold, right? And it's harder to find replacement gold, and so you decide, I'm going to find my gold first. I'm going to find that suitable replacement property first, and I may have to close on it before I find a buyer for my property. And you can do that in what's called a reverse exchange. What you cannot do is own both properties at the same time. So you have to park title to one of the two properties, usually the property you're purchasing, with us. So what happens is we buy the property, and then you sell your property, and then you buy the replacement property from us. Okay? The way this works in the diagram, we have an exchanger who finds a property they want to buy. They have to close. So we set up something called an EAT, an exchange accommodation title holder. It's a single member LLC. We are the sole member. We go buy the property. Step one, the taxpayer loans us money because we're not going out of pocket for this. Okay, so between their own funds and third-party financing, we take that money and we go buy a property. Okay, we pay the seller deeds the property to us. We then lease the property to the taxpayer so they have use occupancy, and from our perspective, more importantly, they have responsibility for the property, all responsibility. Triple net lease, so that basically they're the operator of the property. They're responsible for everything. They insure it, everything else. Okay, so at the end of the day, we own the replacement property. They still own the relinquished property. They find a buyer for their property. Oh, they have 45 days to identify what they're going to sell and up to 180 days to close on that sale. They find a buyer. They go to closing. It's a forward exchange. They deed the property to their buyer. The buyer pays us as the qualified intermediary. And then they buy the replacement property from us. So we deed the replacement. Usually what we do is we transfer the LLC to them rather than deed the property. And then with the money we receive from the sale, we basically repay the funds that we borrowed from the taxpayer. So they're getting their sale proceeds, but they're getting it as a repayment of a loan, which is a tax-free transaction. Does that make sense? Yes? 45 days to identify, 180 days to close. Okay, real quick, what's that? That's the same time limits, yeah. Reverse exchange and time limits are the same. 45 days to identify what you're going to sell and up to 180 days to close on the sale. Okay. We can use this same street, yeah.
Any reason why the person that owns the other party, the buyer, the seller, wouldn't want you to do a 1031?
Yeah, when I first started doing exchanges, we used to have some old school attorneys, and now I kind of looked in the mirror the other day and I saw the gray in my eyebrows. I realized maybe I am one of the old school attorneys now. But the old school attorneys, guys that were much older than me, would sometimes, they were dirt lawyers. They were real estate lawyers, and they didn't want to touch anything that had the word tax in it. And so they would tell their clients they couldn't do an exchange. There's really no reason for the deal with somebody in a 1031 exchange. If you're a real estate professional, like a real estate broker, a 1031 exchange client is your best client. Because if you think about it, if they're buying property, they have everything that you want. They have cash, right? Number two, they have deadlines, right? And they have serious repercussions if they don't close. They're going to pay taxes. So they are motivated. They are, cash rich. And they have, incentive to close. So I think they're the best people to deal with. And if you're selling to a 1031 buyer, I hate to say it, it gives you some leverage in the transaction, if you know. Well, that's why I always tell my clients not to tell them until the last minute. I think it's important. People do say the 1031 exchanges are responsible in part for the great appreciation we see in real estate because people will buy stuff at inflated prices rather than pay taxes. I think that's a bad idea, but there are people who will do that. So we can use the same structure to make improvements to the property, right? So if you know you're going to buy a property and it's less valuable than the one you sold, you might be able to make up that difference by making improvements during the exchange period. And the way that works is this is a forward improvement exchange. We go through the forward exchange. $1 million comes, oh boy. $1 million comes to the qualified intermediary. Okay. They close on their relinquished property. $1 million is being held by us to buy a replacement property. They find a property they like, and we buy it for $700,000. We take and title comes to us. Okay, so we take the $1 million, we pay the seller deeds the property to us as the qualified intermediary, or rather an exchange accommodation title holder. Then during the remaining 180 days, we can take the remaining $300,000 and make improvements to the property. We enter into a construction agreement with the taxpayer. We can basically add an HVAC system or maybe repair the roof or something like that. And then at the end of the 180 days, we transfer that property for the $700,000 purchase price plus the $300,000 of improvements to get them to the $1 million of exchange value to fully defer the taxes. Yeah.
So you're holding $1 million.
Yes.
For 45 days, 180 days. You invest the money, it's sitting in a mattress. What do you do?
Yeah, we go to Vegas and we bet on black. Now, the question is, so what do we do with the money? It's the most important question you can actually ask, because as an industry, we handle billions of dollars. So essentially, what we do, and this is why it's important to ask this question, because there are no regulations really, we put it into an escrow account. Okay, so it's a Madison Exchange escrow account, but we put it into sub-accounts. If it's over $2 million, we put it into a Madison account with a sub-account bearing the taxpayer's name and tax ID number. Okay, so that's identified at the bank with each investor. Yeah.
And it's sitting in a money market and a CD.
It can't be a CD because it has to be liquid. So it's typically money market type. They're really more like checking accounts, but they do earn interest. They're not going to set the world on fire, but they earn a little bit of interest during the 180 days.
Can you guess what I do for a living?
You're a banker? No?
Financial planner.
You're a financial planner? Okay. Yeah, so we cannot do anything too speculative with the money. And companies did get into trouble investing the money during the financial crisis, so we don't do that. Okay.
The improvements have to actually be dispersed by that 180.
Has to be dispersed, and it has to be the improvements must be dispersed by the 180th day, and it has to be for improvements actually made. So you cannot just go buy all your lumber and dump it on the job site and call it a day. Okay. Okay, I'm going to move on to qualified opportunity zones because I think I started with 60 slides and they gave me 50 minutes. So. Okay. Qualified Opportunity Zones, this is part of the Tax Cut and Jobs Act of 2017. It created a program where it incentivized people to invest capital gain from any type of investment, not just real estate, into lower income areas called Qualified Opportunity Zones. These were designated by the governors of all the states and approved by the Treasury. They are all set now. We have lists of them. They're out there. They are listed in a federal notice. If you go on the IRS website, there's a map you can check to see if a property is in a qualified opportunity zone. I have to admit it's not the most user-friendly map, but it is there. All 50 states have qualified opportunity zones, including the District of Columbia, and the territories including Puerto Rico and some of the other territories like the U.S. Virgin Islands and Guam, American Samoa. But yeah, some people do think Puerto Rico is another country, but Puerto Rico is eligible for the QOZ program. As a matter of fact, 95% of Puerto Rico is an opportunity zone. That's what they did after the last hurricane. They realized that they needed an investment, so they made pretty much the entire territory an opportunity zone. Okay, a lot of these are college towns. This is based on the median income of the region. If you're below the poverty level in your region, you were eligible. Not every low-income community was selected. There were limits that each state could select. 306 of New York's QOZs are in the 5 boroughs. 306 of 514. Long Island City along the East River, where Amazon was going to build their headquarters, that was coincidentally an opportunity zone, or is an opportunity zone. Okay, so the way this works is you have capital gain from any asset. That means you could sell stock, okay, for our financial planner over here. If you sell stock, if you sell a mutual fund, if you sell gold bullion, if you sell artwork, okay, you cannot do that with the 1031 exchange, but you can invest the capital gain into a lower income community. It has to be invested in a fund, a qualified opportunity fund, which you can set up yourself or use an institutional fund, and it has to be invested within 180 days of the sale. The deadline for investing is December 31st, 2026. The way it works and why this is attractive is that you only have to invest your capital gain. So unlike a 1031 exchange where you have to basically invest your initial basis plus your profit, in a QOZ, you only have to invest your capital gain. Your initial basis is going to be zero because, again, it's all profit, so there's no basis. If you hold the property for 5 years, you get a step-up in basis of 10%. So if you had a $1 million investment, that $1 million is taxable if you do nothing, okay? If you hold it, if you put it into a QOZ, hold it for 5 years, of that $1 million, now only $900,000 is taxable. Okay, you get a step-up in basis of $100,000. If you hold it for 7 years, you get an additional 5%. So now $150,000 is not taxable. So the wrinkle, though, is that in December 31st, 2026, you pay your taxes on the remaining $850,000. Okay, you have to pay your taxes. This is kind of a downside because now you're paying taxes on $850,000, but you have no access to the money to go pay the taxes. So it requires some planning.
Maybe you make money from the time you invest it. Until that time,
Right.
put that money in reserve.
That, and there's also the thought that you might be able to refinance. It's still not quite settled in the Treasury regulations, but that's the thought. Now, so why would you do this? Well, that $150,000 tax-free is nice, but really the biggest perk here is that if you hold the property for 10 years, you'll have paid your taxes after 2026 on what you invested, but any additional appreciation then, if you hold it for 10 years, is tax-free. Okay, so if that $1 million investment turns into a $2 million investment, you're getting $2 million tax-free. The $1 million of additional profit is tax-free, kind of like a Roth IRA. Yeah. Okay? That's why people are doing these. Okay, once again, the basis is increased to 15%. 85% is taxed on December 31st, 2026. All appreciation, it's not all appreciation after, it's all appreciation is tax-free if you hold it for 10 years, and the investment must be sold by December 31st, 2047. I, for one, probably will not care in 2047 about whether or not the investment is sold. I did the math, and I figured that, hopefully I'll still be moving, but I imagine I will be, hopefully a very active and spry 70 to 80-year-old man that's not not interested in qualified opportunity zones. Certainly, I hope not to be standing here. Yeah, I'll be on the golf course, yeah. Okay. Oops, I went too far. Okay, one thing when you buy real estate, I'm sorry, I'm having problems with this. If you buy real estate in a QO, because you also set up a business, but if you buy real estate, you have to substantially improve the investment if you buy it in the zone. So basically, if you buy $1 million investment, that means that within 30 months, you have to basically invest another $1,001 to substantially improve it. There's some things here in the regulations that are still being finalized, which is making it very tricky, because if you do not complete your investment by the end of this year, you're not going to get to 7 years by 2026. So you're going to lose 5% of that 15% step up in basis. You have a question.
If I own a property opportunity zone, it doesn't help me on my taxes, but it can help me on a sale.
Yes. So if you already own the property, you cannot do anything with it. You cannot invest in it, but you can sell it to somebody. So it makes your property more attractive. And the odds are if you own a property in the opportunity zone, you probably have seen a substantial increase in your appreciation. Yeah. Yes.
Do you have to add additional money for improvements, or it's the fund's money?
Yeah, typically if you're investing in a fund, the fund is coming up with additional money to substantially improve. But if you were to do this yourself, it would have to be your money. But a lot of people are using institutional funds. UBS has a fund out there that they worked with RXR. Inland Capital, who's a DST sponsor, they now have a fund. There's a couple other institutions out there as well. Yeah.
On sale of the property, and I want to go ahead and invest in opportunity zone, do I still have to pay depreciation recapture?
Do you have to...
Sale of my first property, then I go ahead and invest in opportunity.
I don't. That's a really good question, and I don't remember. To be honest with you, I'd have to look at the regulations again. I don't think so, but I don't recall off the top of my head. Yeah.
I might have missed what you said, but what has to be done to the property?
It has to be substantially improved within 30 months.
What's exactly?
That means you have to add, and basically you have to exceed your basis in additional investment. So if you bought a property for $1 million, you have to add $1,001,001 to it. So this is really better for a development project than it would be for somebody who's doing a rehab, right? There is some guidance out there that says if you buy a vacant property and the property has been vacant for 5 years, you don't have to substantially improve it. Kind of a weird wrinkle. I know some tax advisors who are trying to get that reduced to 2 years. The IRS still has to issue final regulations, which hopefully they will have shortly, but they're not there yet. They're just still accepting comments, or I think the comment deadline just passed. Okay. Okay, let me compare 1031 with QOZs. The rumble in the tax jungle, 1031 versus the QOZ. Qualified opportunity zones. You only have to reinvest the profit. In a 1031 exchange, you have to reinvest your basis and your profit. Oh, that came out dark. Now my screen is very dark. I can't see that too well. QOZ, there's no identification requirement. You just have to invest within 180 days. We have 45 days to identify in a 1031 exchange. In both, we have 180 days to reinvest. We can basically sell any type of tangible property, any type of investment property, including stocks, bonds, etc. In a 1031 exchange, we're limited to real estate. Only low-income communities can be invested in with a QOZ, whereas with a 1031 exchange, we can invest in any area within the United States. All states and D.C. are eligible for this program. All territories, including Puerto Rico, are eligible for QOZs. We cannot do 1031s into Puerto Rico in a 1031 exchange. We are not able to sell foreign property or buy foreign property in a QOZ. There is the potential of doing an exchange of foreign property, but not into the U.S. with a 1031 exchange. So you can basically sell in Israel, you could buy other property in Israel, you could buy maybe in another country as well. Deferred gain in a QOZ is going to be paid. The tax is paid December 31st, 2026. In a 1031 exchange, we basically will defer that capital gain and the taxes indefinitely. The appreciation in QOZ is tax-free after 10 years. A 1031 exchange, that's not the case. We must sell by December 31st, 2047 with a QOZ. In a 1031 exchange, we can keep doing this for as long as we live. We call it the swap till you drop. Right, so if you sell properties and you keep exchanging until you die, well, under current tax law, your estate gets a step up in basis and the capital gain disappears. So we have the ability to swap till you drop. We don't have that with a QOZ. We have to sell in 2047, unless, of course, I guess you drop first. Okay, with a QOZ, there is no mortgage boot netting. That means if I sell property for $1 million, I have a $500,000 mortgage to pay off. With a 1031 exchange, I can go buy a property for $1 million, spend my $500,000 in cash, and take a mortgage for the additional $500,000. In a QOZ, I have to invest cash. So if I have a $1 million capital gain, I have to invest $1 million in cash. I cannot borrow to basically fund I could borrow against other assets, but I cannot borrow on that asset when I acquire it in the fund. QOZ, the ability to refinance is unclear. It seems like we should be able to refinance. That was the latest series of regulations. There's some limits to that. In a 1031 exchange, we can refinance after the acquisition. I would probably argue that 95% or more people do refinance after their acquisition. QOZ, S corporation shareholders basically can separate. In a QOZ, we don't worry about drops and swaps or any of that. If you have an interest in a business as a partnership or in a 1031, in a S, you give me the pie sign over there? No. I thought I was getting the hook in the back. Or an S corporation shareholder, you can separate and go your own way. In a 1031 exchange, S corporation shareholders, very difficult to separate and go buy different investments. We can do it with partnerships, but S corps are really tough. QOZ, it requires a qualified opportunity zone fund. We don't have to have one of those in a 1031 exchange. Oh. Okay. Bear with me. Regulations are still being finalized in the QOZ. We know what the regulations are in a 1031 exchange. We've had them since 1991. You do not need a qualified intermediary with a QOZ, but with a 1031 exchange, you benefit from the knowledge and experience of a knowledgeable and very wise qualified intermediary. So you have somebody walking you through the process. Okay, so what's the end result? Well, you've already seen it. It's a unanimous draw. It really depends on what your investors' objectives are. Okay, if you have somebody, I wouldn't recommend a QOZ for somebody who's retiring from the 3 Ts, right? They're selling their property because they're tired of tenants, trash, and toilets. Typically, those people probably want something a little bit more passive than a QOZ. They maybe not want to speculate, especially a retiring shareholder, a retiring property owner. They may not want to invest in a low-income area, right, where they don't know what the returns are going to be. They may want to buy something like a Delaware statutory trust, which is another type of property that somebody else manages, and you're a passive investor. Okay? I'm not sure how I'm doing on time. Is anybody here to give me the hook? I'm going to keep going until somebody screams. Okay. Okay, cost segregation. Anybody familiar with cost segregation studies? Okay. So essentially the way this works, we talked about depreciation being one of these big benefits, right? We get to take a portion of what we invested and pull it out as an expense when against our income on the property. And so the one downside of doing that with real estate is that the amount of time it takes to fully depreciate a property is very, very long. Tax law requires that a commercial property, you have to depreciate it over 39 years. Okay, so it's a very long depreciation schedule, and it means it minimizes the impact over, especially the early years. It's because you're taking 1/39th, it's not even. So only the building is depreciable and the land is not. So if you bought a property for $1 million, $700,000 might be allocated to the property. Now you're depreciating that $700,000 over 39 years. So I don't know the math, but it's 1/39th of $700,000 every year is what you get to take as your benefit. For a residential property, a residential rental property, it's 27.5 years. It's a little bit better, but still not great. So what we do with the cost segregation study is we reclassify our property. So we say that, this club here, right? It's a building, it's commercial, we'd have to depreciate the value of this building over 39 years. But this is not just a building. We could break this building down into its component parts, and some of the component parts, like personal property and landscaping improvements, you can depreciate much faster. So instead of 39 years, the value of all this landscaping outside can be depreciated over 15 years, okay? Less than half the time, okay? Any kind of movable walls, the bar, right? That's personal property. And so that might be able to be depreciated over 5 or 7 years. And so you get a lot of bang for your buck up front. And those first, 1 to 15 years, you can accelerate the depreciation and really reduce your taxable income each year. Okay, and the way this is done is you do a study. And we have a company called Madison Specs, and they come in. I say it's like 2/3 of a bad joke. It's you have an accountant and an engineer walk into a bar, right? If they had a priest or a rabbi or somebody else, it would make the joke complete, and you can complete it. But they walk into a bar, and instead of having a drink and telling an awkward joke, they basically look at the building and they say, okay, this is personal property, this is landscaping improvements, this is building, and we're going to give you a report. And now of the $700,000, maybe $200,000 we can depreciate over 15 years or from 1 to 15 years. and it goes by much faster and reduces your income. And most of our owners, most of our clients don't own the property 39 years, so they'll never get the full benefit if they wait. And so they'll do a cost segregation study. 2 minutes? Okay. Okay, so it reduces the income immediately. If you own the property for a period of time, you can do a catch-up and do the deductions in 1 year. So even if you've owned the property 5 years or so, you can still reclassify and take that deduction all in 1 year for the prior 5 years. You could do a file form 3515, which is kind of complicated. I won't get into that now. Since I only have 2 minutes. And by the way, if you send us your card or send us your information, I guess maybe they'll give us a registration list. I'll email you the PowerPoint deck. I'm more than happy to share that. But I have my cards here too. If you want to shoot me an email, I'm more than happy to send that out. Since I only have 2 minutes, one of the questions becomes now, what's the crossover between a 1031 exchange and a cost seg study? So, the thought is because we can no longer do a 1031 exchange on personal property after 2017. Are we able to do a 1031 exchange if we've done a cost seg on our property? Because we've taken our real estate, now we've turned it into real estate and personal property, right? And the thought is that even though you're reclassifying for depreciation purposes, that does not necessarily limit your ability to do a 1031 or include that value in a 1031 exchange. This is still being settled by the IRS. You may, if you're an accountant, you may be familiar with the 2017 Tax Act, and or if you are an accountant, it created a lot of upheaval because the regulations were not finalized in time for a lot of the tax return stuff. They were all focused on the 199A and all that stuff last year. And so we're still waiting for some final guidance on a lot of this stuff. Oops, I went too fast. So that's my presentation. If anybody has any questions, I'm more than happy to answer them. Thank you.